inflation, Fed rate, how the central bank increase the repo rate and everything. So that is what we will see here. We will be comparing the growth stock or growth index versus the value index. Now what is this growth stock, value index or value stock? We will see that as well. And I have added a little market sentiments here. I mean, we will study the news and based on that we will predict the market. So 5 days after how they performed, okay. XLK, again it's the tech stock, I mean it's the growth stock. You can see how after the repo rate how it performed. On the other hand, XLE, that is the energy sector, and XLEP is the consumer sector, and you can see it did not fall that much as compared to the growth stocks, okay. And then after 5 days how they performed. Now hypothesis 2, the AI anomaly. Historically Nvidia, now what is this beta thing? Very simple, okay. If the market is going down by 1% and if there is a stock has beta 1.7 or 2, let's say if beta is 2, then we can say that if market is going down by 1%, then that particular stock will go down by 2%. So here historically Nvidia has the beta 1.7, so it should crash harder than the market, right? But if you will see here, the blue one is Nvidia, it did not fall that much and it recovered very well. Now what's the reason? We all know in 2022 November the ChatGPT launched and there was a shortage of form like this. Okay, I'll just remember, I'll note down. That's not true. It could be misleading. So we computed 95% standard error band. So since the confidence interval shaded, okay, let me show you the result first. So the blue one, this blue line is the growth stock. Growth stock means the one which is not stable. On the other hand, the green one is the value stock. So I have made that 95% confidence interval that the growth mean will be in this interval only, okay. Whatever the market perform, 95% I am confident that it will be in between this. It will perform between this thing. On the other hand, value mean, if you will see this one, so of course you can see the value stock is less volatile and far better than the growth stocks, okay. This is something very interesting, okay. So now methodology, NLP on trade speak, VADER sentiment. So here I have added some news thing because this is true that market get affected by a repo rate hike, but not always. There could be some news things as well which can affect the market. So VADER sentiment analysis, well as aware dictionary, okay. There is one dictionary in VADER algorithm. So what they do, so the question is, can we predict growth return using only value return and sentiment? So the logic is, if market rotation is mechanical, that is sell growth, buy value, okay. It's like if we already get an idea that okay, based on the scrapping of the news, if we get an idea that okay, the market could fall, definitely what we will do, we will shift our money from the growth stock to the value stock, because what we want is a return. We don't want volatility. If we know that okay, it's growth stocks are volatile, so it's better to sell the growth and buy the value. So the second is LSTM. This is something really interesting. This is a deep learning thing, a long short-term memory. It's like it has brain, it has memory, so it remembers the previous data and based on that it predicts the next move. So long short-term memory, that is RNN, recurrent neural network. Why LSTM? Capture the temporal dependencies and memory of recent volatility that linear models miss. So training 60 days, look back window, and what will be the result? Highly accurate. Let me show you the results. Okay, here I have taken the value of 140 days of thing. If you will see, the actual growth index is this one, okay, the black one, and the red green one is the LSTM prediction value. You can see it is somewhat very accurate. I mean, it is just following the trend. Now mathematical framework of GARCH. Now what is this GARCH? We have talked about LSTM, we have talked about XGBoost. It's all related to price, but it's time to focus on volatility. That is what is the main thing, right? So if we are talking about GARCH, then we are talking about the volatility. So standard model assume constant variance. Okay, variance is volatility, you can say that. So financial time series exhibit heteroscedasticity. Now what it is, I'll explain later. Now variance equation, sigma square is equals to omega alpha psi square t minus 1 beta sigma square t minus 1. Now okay, I did not mention what omega is. Omega is, we all see the volatility in daily market. There is some volatility. that is what is the omega. Now what is alpha, sigma, psi square minus 1? It is arch term, impact of yesterday's shock. It is not volatility. Okay, so you can see how the market reacted based on that particular news yesterday, and based on that we can see how it will perform today or tomorrow. On the other hand, if you will see beta sigma square t minus 1, this is the GARCH term, persistence of the past volatility. This is not past shock, this is past volatility. Okay, this has a memory. Like if a market did not perform well yesterday, so we can